Hello friends, in this video we want to talk about the price action, key levels and price action. The first type of key levels are the major key levels which you can locate easily from the first glimpse at any chart by defining swing highs and swing lows. The following chart shows daily major key levels for the pair EUR or USD. Some prefer to set levels at the nearest round number if possible. If it's still not clear how to locate these levels, then don't worry, because the next chart has the same levels with added colored markers to indicate the key areas above the below the levels. Each group of pointers of same color is assigned to one level. The second type of key level is the minor key level, which in some cases acts as a second option for a major key level, and when combined together, they form a key zone. Although they have a less significant history compared to major key levels and could cut through a wide range of candles. In the following chart, minor key levels were added, using a different color to differentiate them from major levels. Once again, the next chart with added colored markers for a better visual explanation. We've taken the chart which has both major and minor key levels and we divided it into two sides by a vertical black line. From the left side of the chart to the deliver shall be considered as history and the right side as present time. The location of the separator was intentionally chosen because the same levels could have been located up to this stage without the existence of the right side. Price was moving above the lowest major key level, then it moved up, breaking through the higher major level with momentum and closed above it. The next candle retested the level and closed above the higher minor level, followed by multiple retests of the same level without any close below the level. Later, it tested the next minor level and failed to close above. Price consolidated in between the two minor levels. When the decision was made, the price broke through the upper minor level and the next major level with high momentum and closed above the two levels and below the next major level. Third candle broke through the major level, closing above it and below the next minor level, followed by a retest of major level and a close above the high minor level. The next candle broke through the higher minor level and closed slightly above it and retested with the second candle, before moving up with momentum breaking through the next major level and closing above it. Price failed to break the higher minor level and broke down through the major level with a close below followed by a retest and drop. Price continued dropping, breaking through lower levels till where it fails to break the major level and closed above it. This was the first retest of this historical major level after a long time, and we can see price bounced from it too. Now, we'll speed up the process a bit and concentrate on bigger moves. At price had another retest of the same major level, failing to close below it, and it went up to where it broke through the major level with a close above. But the next candle broke through the same level in the opposite direction and closed below. After a retest, price declined to where it closed above the major level, and this was a fresh retest of a historical major level. A retest was done by the fourth candle and price railed up to, and this is where we stop. I think now you can see the importance of key levels and candle closes. I left enough candles for you to read by yourself. Key levels are highly respected by price, and if price breaks through it and close above or below, then it's a sign of where price will go next. In most cases, it will travel to the next level. More often, price will give another chance for entry when it retests the strength of broken level before moving to the next. When price breaks through a level with high momentum and closes above or below without a retest, then it's a sign of big buying or selling. Gap. This content will answer any questions you might have above what is the definition of liquidity gap, and how and why you expect price reaction in relation to it. There is no easy way to answer this question as it requires a study of the market microstructure, which explains how the exchange occurs in financial markets and the order flow process. But we'll try to make it short and simple. We know that in a normal liquid market, there is a seller for every buyer and vice versa. This is considered a stable state of the market as it creates a balance between supply and demand and maintains a stable price value. And as the imbalance occurs in supply and demand, the value of price increases or decreases. The balanced state on a chart is represented by a consideration in price, and the imbalance is presented by a high volume of a momentum candle, also known as a sign of pro-money or institutions buying or selling. If we zoom into the consideration, we'll find other states of balance and imbalance. The order flow has explained the execution of orders, and to recap, to have your orders executed at current price, you need someone on the opposite side with the same number of orders, otherwise price will move too much from your entry until it finds an opposite stack of orders. Retail traders have a big advantage over pro money since their orders get executed at current price, a benefit that pro money doesn't have due to their mass orders, which gets executed at different prices as the price moves away from their initial entry. Hence, they tend to accumulate or distribute their orders through positioning, re-entering on retracements, or even creating them, as well as fake-outs. By now, you should understand why the sign of pro-money buying or selling is presented by high momentum candles aka liquidity gaps. But if you don't, then continue reading. A liquidity gap means low liquidity. You know that in a liquid market, for every buyer, there is a seller and vice versa. But you also know that online brokers don't guarantee a non-slippage or a no-recourse during the time of volatile news due to low liquidity. And you can clearly see it on charts during such news when a long spike or a high momentum candle is created in seconds. A broker wouldn't take the risk if you're buying because they can't find you a seller unless they are willing to take the risk by selling to you as a dealer. So how could we say it's a low liquidity when price moves in a high volume? We know that high volume candles are signs of big money, institutions, etc. entering the market or in control of the market pushing price in their direction. That's true. However, the liquidity in this case is being injected from one side only, hence the name liquidity gap and the equation volatility equals high volume plus low liquidity. The normal or balanced state of the market is to have a seller for every buyer, thus maintaining an efficient change in price value. So when the market moves up or down either in consolidation or in a ladder steps behavior, then it's a normal balanced state. But if it moves up or down with a high volatility and momentum, then it's abnormal or imbalanced state, and it's a sign of domination for one side. So what is the conclusion? The dominant side, pro-money, would want to collect their profits as soon as price reaches their targets, which results in market returning to its previous states, rebalancing, on a wider scale and filling up the liquidity gaps. The definition part of the question has been answered. Now let's answer the other part related to price reaction. Look at the gold daily chart and see the price behavior when it broke through a decision area or major key level of significance, creating a high momentum candle as a sign of one side in control, bulls or bears, and how they wanted to push it higher or lower. Of course, price will return to fill the gaps, but later in the future, not at the present time of the incidence, especially not when it starts creating a new supply or demand as pro-money position their entries. On the other hand, you can notice larger high momentum candles getting filled the same day or next day, but this happens when price fails to break through a major or key level, and this is when pro-money are accumulating or distributing. The market is in a constant state or phase shifting from normal to abnormal, balanced to imbalanced, and back again, just the same as in ranging to trending to back again. And every range contains the two phases if you zoom in. The same applies to the bottom consolidated area in the chart. Supply and demand trading style is in harmony with order flow and it works according to this stuff.